Hi folks, this is Ariel Baruch in Sierra Cast TV studio out of central New Jersey, and today I want to talk on our sequential topic. We already made several videos, but today we're going to talk about purchasing a property in Pennsylvania. Our previous videos were on purchasing property in New Jersey, and also we talk about doing cash out refinance on home loans. We did the New Jersey property that we had another video on was purchased in South Jersey, and I provided the numbers. The property purchase price was roughly $200,000. And then another video we did on cash out refinance for an investment property, and that was an excellent video to show you the breakdown of numbers and how it works with investment properties, and just in general give you an idea what cash out refinance is all about, and what are the numbers and what people can expect. So in this video, we're gonna talk briefly about purchasing home in Pennsylvania and how is it different versus purchasing home in New Jersey. So on the screen, you should see some numbers. So in this specific case, you can see the purchase price is $300,000. The borrower decided to pay, and by the way, these are actual numbers. This is not made up. This is all these numbers were copied from our proprietary software called Encompass. They were copied into Excel, and also in Excel I recreated the calculation formula so you can see exactly how it is calculated. But it's the same numbers as in the proprietary software that we use, Encompass, and these are actual numbers. So the purchase price is $300,000. Borrower decided to pay 5% as a down payment. Interestingly, that specific borrower did not have very high credit scores. It was actually slightly lower than 700. So the borrower, and also borrower was over leveraged, so there was quite a few debts to pay. So the so-called debt to income was relatively high. The person had a number of loans and a number of obligations that he had to pay. So for those reasons, debt to income ratios plus credit score is not that high. It was less than 700. The better program was to use to actually buy that specific property was to use FHA program. So the numbers you're going to see here is for FHA loan. FHA stands for Federal Housing Administration. They provide loans that help people who don't have much money saved, or people who have lower credit scores, to get foot in the door, so to speak, to buy property so they can become property owners, so they can start building up equity in their own home, so they don't need to pay rent and they can really invest in their own home. Because the good thing about the homes that there are tax deductions. It's excellent benefit. Like for example, interest rate up to a certain amount can be deducted on taxes, and for people who pay a lot in interest rate, that can be a significant amount. So that's good. Overall, it will decrease their taxable income, and sometimes it can decrease taxable income significantly. So that's a great benefit. So to be a business owner, another thing is there are other advantages. For example, it's your property. If you buy a home, it's your property. You can do with it whatever you want. So what happens is that a lot of people end up doing what we call forced appreciation, where the borrower invest money into the property, and several years down the road may decide to sell it, or may decide to rent it out, and move on and buy another property, and then move on and buy another property. This is how a lot of people become serial real estate investors. They buy property, they do forced appreciation, they fix it, they change the appliances, they repaint it, they fix the roof, and then they rent it out and they move to another property. Especially for people who don't have children, they kind of they just maybe married couple and they want to just invest in real estate property. So this specific property is $300,000, 5% down payment chosen by the borrower, 30-year loan. And interestingly, in Pennsylvania, in this specific case, the total property taxes were actually pretty high by Pennsylvania standards. It's almost $11,000, $10,800, but it comprised of township tax, $800, and then was a county tax, $2,000, and then there was a school tax, which was $8,000. It's significant, even by New Jersey standards. Like for somebody to pay 10,000, I'm sorry, 11,000 just in taxes, that's a lot of taxes. So annual property insurance, which is a hazard insurance for this specific property, $1,200, and then interest rate. So this person, even with all the debts and obligations and moderate, I would say moderate credit scores, person was able to get 2.5% interest rate, which is quite remarkable by loan standards. Of course, this happened during the COVID-19. This loan was closed in June 2020, so the rates went down. That definitely helped that borrower. But 2.5% is a pretty good interest rate if somebody wants to invest in a real estate property, because guess what? The real estate, if person take care of the property and fix it and upgrade it, the value of the property will go up, and then essentially the person will cause forced appreciation. So for example, this person bought property for 300,000, but by investing a fairly low amount of money, they can appreciate the value of the property. So next time around, when appraiser comes in, let's say a year or 2 years from now, that property can be evaluated at a significantly higher value. So because it's FHA loan, there are two insurance premiums. There is upfront insurance premium 1.75%, and then there is also a monthly mortgage insurance premium, which is 0.8%. By selecting 5% down payment, it actually decreased this monthly mortgage insurance premium from 8.85% to 0.8%, which essentially reduced the monthly payment. The person decided to pay 5%, which is 15,000 as a down payment. So the monthly payment is roughly 2,300. So there's a principal and interest, let's say $1,100, and then there's a property insurance $100. There's a monthly property tax $900, and then there is a monthly mortgage insurance roughly $188. So altogether it's roughly $2,300 monthly payment, which is pretty good considering, because this is $300,000 property and has a lot of taxes. That specific property is in a good school district, so not surprisingly the school taxes are pretty significant. So total charges for the rate chosen to get that 2.5% interest rate, the person actually paid 0.5% of the loan amount, so which is roughly $1,400. Origination charges were roughly $1,500, and then the fees for the services borrower cannot shop for was a $550 appraisal fee. That's required because the bank, before bank lend the money, they want to know that the property is worth what the seller is asking for, in this kind of $300,000. And then there is a title review fee, $200, and then there are some other fees that the borrower can shop for. So that's important. So the borrower can actually choose who he wants to use to do all the title work, and in this specific case, the borrower chose the work with the title company that was recommended by the mortgage company. But borrower can shop around, and if borrower has a title company that they like to work with, or maybe they worked with in the past, they can always use that company. The caution of the warning here is that the caution, I would say, is that really work with a reputable company. Try not to choose title company out of state, because it can backfire. I had a case where a client chose out-of-state title company, and then it slowed down the progress. It actually delayed closing date by several days. It was roughly 4 days, because there was some issues that had to be resolved and with the out-of-state title company. So just keep this in mind. Sometimes it makes sense to pay a little bit more for the title services, but knowing that this is a reliable company, you can trust them, and if there are any issues, they will be able to quickly resolve it. So in this specific case, there was a closing protection letter fee, $125, endorsement fee. There was a lender's title insurance policy that protects the lender, because the lender is forking over $300,000, and they want to make sure that if somebody shows up later on and say house belongs to them, this specific fee, this lender's title insurance policy, protects the lender, so the lender will get the money back if something goes wrong. Then there are some other fees. There's notary fee, settlement fee, PA tax search, Pennsylvania tax search fee, and that was it. So in this specific case, the title company charged only these fees, and a bulk of it was essentially just the lender's title insurance policy. All other fees, they're fairly small. Settlement fee was only $300, and then there are some government fees. So there's a mortgage recording fee, and then there is in Pennsylvania specifically, there is essentially a deed transfer tax. So it was broken down into township had a township had a $750 tax, and then there's a school had a $750 tax, and then there is a state had $1,500 tax. So that's kind of thing that people experience in the Pennsylvania, is that they should know about these taxes. Typically, this would be split half and half between the seller and the buyer, but the contract of sale can actually specify who pays these deed transfer taxes. It can be seller, it can be buyer, it can be both. Split 50-50. Okay, so the prepaids in this specific case, so there are things like prepaids and there are things like reserves. So they serve in a reserves over here. So they serve in a different way. So prepaids and reserves are really there to pay all these different taxes. So specifically in this case, prepaids were the property insurance. The bank required property insurance to be paid for 12 months. In this case, $1,200. Prepaid school tax. So the bank actually required, and it's Pennsylvania thing, bank required to prepay 12 months of school tax, and in this case it was $9,600. So that's a significant chunk of money that's part of the closing fees, was essentially to pay the school tax. And the reason for that is because that specific school tax is paid once a year. It's not paid quarterly like in New Jersey. And the loan was closed within 2 weeks of when this tax was due. So that's why the bank required this full amount for 12 months to be paid. And then there is a prepaid interest. In this specific case, loan was closed roughly 15 days before the end of the month or before the beginning of the next month. So the prepaid interest was $297. For the reserves, the bank required to pay property insurance for 3 months. So essentially, reserves serves as a cushion if something goes wrong. If some taxes were underestimated, let's say taxes were estimated as $10,000 and actually it's $11,000, this reserves is what will help to kind of offset those numbers. So the bank will go back and take some money out of those reserves and kind of help pay for things that were underestimated. So in this case, 3 months of property insurance, $300. 3 months of township tax, $333. Was 5 months of county tax, $833, and then the 2 months of school tax, $1,300. So all in all, those reserves were $2,800, and then there was some other fees. There was a owner's title insurance. It's optional, but it is recommended. It protects the amount of money the borrower put down as a down payment. In this case, was 5% of $300,000. That's essentially protect borrower's money. If something goes wrong, if somebody show up and say the home belongs to them, the borrower will get his money back. Then there was a broker fee. Essentially, it's commonly real estate's agent office will charge that fee. And then there was some adjustment to seller for overpaid taxes. It was $2,500. So apparently the seller overpaid. So that was $2,500 will go back to the seller. And then all in all, so there was no seller's concession because that specific property was actually owned by the bank. The seller was the bank, so there was no seller's concession. Bank did not agree to any of that. And paid before closing. So there was appraisal fee, $550, earnest money deposit by the borrower to kind of make clear to the bank that the borrower is really interested in purchasing this property. It was $5,000, and there was a tax credit from seller, $1,500. So this tax credit was because of again, when taxes are paid, it can be prepaid or it can be, in this specific case, the seller did not pay the taxes, so the seller had to pay for the taxes at closing. In this case, $1,500. So all in all, cash from borrower at closing, $34,000. So this should give you a rough idea how it works. You know, I know there are quite a few numbers that go into this, but all in all, this shows how these calculations work, and it is quite involved. You know, it requires both borrower and the loan officer work together to kind of come up to understanding of all these numbers. So that's definitely a process. I hope you found this useful. This specific property was purchased in Pennsylvania, so there are some nuances, like for example this huge gigantic school tax that had to be paid up front essentially, because the property was purchased within weeks of when that amount was due, and that amount in Pennsylvania, in that specific locality, in that township, has to be paid once a year. So this huge chunk of money, almost 11,000, was part of the closing costs. So just keep this in mind if you're purchasing property in Pennsylvania. If you have questions about it, feel free to reach out to us. You can call me or send text message. My phone number is 609-222-1222. Again, my phone number is 609-222-1222. Reach out, ask questions. We'll be more than happy to help you. You can also reach out to my office I'm affiliated with, which is Contour Mortgage out of Robbinsville, New Jersey. Just Google on the Google Maps and you'll find it. It's a Contour Mortgage out of Robbinsville, New Jersey. Otherwise, feel free to leave comments, suggestions. If there are any topics that you're interested in and you want to learn more about, we'll be more than happy to research it and make another video for you. Thank you for your attention.